try to keep it brief. So again, Amanda Holbrook. Nice to meet everyone here, and thanks for tuning in. So we're a specialized trust company. I have been in the self-directed IRA arena for 13 years now. So yeah, got my start in with the large 900-pound gorilla in the room that shall remain nameless as far as the self-directed custodian. I was their top producer for a number of years. Corporate just got too corporate. We shook hands, parted ways, and I got back into the investment side, where as a senior portfolio manager of single family portfolios across multi-markets. So I brought a good chunk of the investment side of the business to the table when Keith and Edwin, the proprietors here at Specialized, were just even talking about starting Specialized Trust Company. And I said, count me in for sure, because this has always been my backbone. It's a very niche as far as what self-direction is and what we do. And I love being able to help businesses and families, invest in what they know, by taking control of their own retirement, because the results are just outstanding. So I'm very passionate about what I do. If you are lucky enough to sit next to me on a plane or in a lounge or in a hotel or, right here on our phone or Zoom here, you're going to hear the same story. No matter what.
Awesome. That's great, Amanda. Thanks for sharing. It sounds like this is a really great fit for you. So congratulations.
Absolutely. And so let's get to, your money, your future, your way. Why would we have it any other way? Okay. I mean, we go to school, we bust our humps, we get a job, we build up these nest eggs of 401ks and IRAs for what? So that we can retire, right? So that we can enjoy financial freedom. Is that a fair, analysis there? So why wouldn't you want it to be, it's your money, it's your future. So do it your way. You don't have to subscribe to somebody else's model. So be the differentiator. Take control and say, okay, I love this plan, but why are we doing it? Why aren't we doing it a different way? There has to be a better way, and that's where we step in. But before I go with the solution here, Will, you have to know what are the three forces that are working against all of us, right? I mean, it's uncertainty, unpredictability, right? We don't know. Will, do you control the stock market?
No.
Over there I don't know about.
I don't think I'd be sitting here chatting with you if I had that much control.
Right. But it's, we all kind of gamble with it, right? Because we don't have that control, but that's where, so many of portfolios are all in the stock market. So we'll come back to that. I mean, too expensive loads and commissions, you shouldn't be overpaying. And that's one of the big, the big things, whether it's here on a Zoom call or, when doing events was a thing, I would ask a room of 500 attendees of what do you pay for your 401k and IRA, and no one ever knows. You know why? Because it's not disclosed right up front. So I'd love for you
really got to dig for that information.
Yeah, it's just not right up front. And with self-direction, it has to be. And it's just how how the compliance piece works. And the last but not least, we're going to figure out how to not pay so much in taxes. Would that make everybody on here happy? If I gave you even just one little nugget of how to pay less in taxes, this would be worth your time, right?
Absolutely.
I hope so. So the big tool we're going to talk about here is self-directed IRAs and 401ks. And for those of you that have never been exposed to this, this is the same type of IRA 401k. It's the same rules that you've heard about. So name your big bank here, wherever you have your IRA or your 401k, it's the same rules. So here's the big guys, and they say you can invest in stocks, bonds, and mutual funds. Okay. That's it. Okay. That's all that they say that you can invest in. But when in reality, instead of this little sandbox full of toys, you have a whole playground out there of real estate, notes, entities, private placements, self-storage, mobile homes, you name it. Okay. But those big guys, what they do is they narrow that lane well. So They don't have to offer those to you. So in lies companies like Specialized Trust Company. We're a passive custodian, no recommend or endorse scientific investment or investment sponsor, but we give you the opportunity to invest in what you know. Okay, that is a key. Sorry about that.
It's all good,
guys. Everything rings over here.
So it looks like, there's a bunch of different, when you have a self-directed IRA, it opens it up to what you can invest in. So Amanda, you touched on this earlier that, invest in something that or something that you believe in, and so if you know a neighborhood, or if you know your community and you like the real estate in that area, then that's something that you can invest in with a self-directed IRA versus, not having the ability to do that in sort of the traditional accounts that only have, stocks, bonds, mutual funds, those types of products available. So
it's the way I always put it, Will, it's a way to diversify off of Wall Street and onto Main Street. So whether that is through like your company's due diligence and funds and projects in various markets, or a rental property in your backyard, to your point, but the point here is there's, whether you are, a seasoned investor, I'm willing to bet you have a ceiling, a floor, and 4 walls around you. That's real estate. Everyone needs somewhere to live. All across the country, all across the world, so would that be a considerable tangible investment? You tell me. So kind of going back to, if you look on your screen here, guys, there is over 27 trillion with a T of funds in retirement accounts. So when I say retirement accounts, think of your own scenario. Think of your sphere of influence, your friends, your family, your colleagues. How many times have you switched jobs? Guess what? You have a 401k that you can self-direct. You have an IRA or a Roth IRA. You can self-direct those. If you're in the government, you have something called a TSP, which is their version of a 401k. Or, a lot of times nurses and teachers have 403Bs, same type of rules. If it's an old employer's 401k, which statistically, the average 35-year-old has switched jobs 4 times. This past year with COVID, how many folks have lost their jobs or switched jobs? I tell you what, I work with a lot of pilots that were furloughed for amount of time. You know what I did with those clients? Guess what? You can move those 401ks during those periods. It was a beautiful thing. So they were able to take control of their money. And then when they went back to work, they still participate in that 401k, but now they can invest it in stuff that they want outside of the market. So they were able to diversify. So diversification is why we're talking today, and how you can get some money in these accounts and reduce your taxes. When I talk IRAs or 401ks, a lot of folks just think, oh, those types of accounts. But everything you see on your screen here, folks, if you're self-employed, SEPs, 401ks, IRAs, those of you that have children, covered educational savings accounts, health savings accounts, it's the classic double dipper account. You have a high deductible health plan. All of these on your screen here can be self-directed. I repeat, can be self-directed. You can invest these in what you want. Now, I'm not going to sit here and say put all your eggs in one basket, but going back to this, it's control and diversification. And I know, Will, you've got some great stuff coming up on the market.
So speaking to that, we'll talk a little bit about, why we think, or why I think it's compelling for you to be diversified, particularly into real estate. And so let's just briefly talk about why you should consider that. I think everyone is relatively familiar with, the stock market and the ups and downs that it's had over the past. But if we go ahead and jump into some examples that we can draw upon from history, it's gone through many extreme ups and downs. And when we look back, we're reminded that, yes, a market crash is very bad and a difficult thing to go through. but it is something that we can overcome, and generally we do. So if you look at the Great Depression, over the course of a few days, the Dow dropped 24.8%, and it did take a little over a decade for the economy to get back to pre-depression levels. This happened again in 1987. The market lost 22.6%. That was known as Black Monday. But within 2 years, it recovered everything that it had lost. We saw another dip or a crash in the early 2000s. That was the dot-com bubble. That was driven by speculation in the mid to late 90s, and it all came crashing down. And then that was further impacted by the events on September 11th, 2001. I think everybody remembers where they were on that day. And then that recovery took more than 2 years to get back to the levels pre-crash. And then again, it happened in 2008. The Dow Jones Industrial Average lost about 50% of its value in a very short time. Again, though, it did come back. It took a couple years, and the market was stronger than ever before. And we've essentially been in a bull market, which is a period of significant economic growth, basically from 2009 to just before the coronavirus crash. And then the coronavirus crash, as everybody knows, because we all were around for that one, happened in March 2020, and this triggered the most rapid global crash in financial history. However, the stock market again regained ground relatively quickly, and the year closed with record highs in all major indices. So, as a financial advisor before, during the 2008 recession, I can speak personally to knowing how challenging it is for investors to not panic and sell during the dips, thereby actually realizing losses if they would have just heeded my advice or the advice of most advisors to stay the course. In fact, maybe you should buy the dip because you'll get stuff on sale. Then you come out way ahead. The problem is that just doesn't happen because it's challenging, it's emotional. And then conversely, never in my time as a financial advisor did I have a client say, during a major upswing or a major bull run, I think this is enough. I think it's time for me to maybe take some money off the table. That never happens, not once. And so with all that said, one of my favorite quotes sort of illustrating this point of kind of, what you should see overall is by Warren Buffett. And he says, be fearful when others are greedy and be greedy when others are fearful. So just looking at what's going on right now, it might be time to be fearful of equities or stocks. So here's a chart. We'll just look at some data here. This is the NASDAQ historical chart, and the gray bars indicate recessions. You can see that most of the major dips or corrections in the markets are during or shortly after recessions. Speaking further to the point of irrationality, you can look at what has happened with the Reddit channel Wall Street Bets, and the GameStop, Nokia, Bed Bath & Beyond, and a few other companies. And I realize that there's a lot more to that, and it's kind of more of a story than meets the eye. But Main Street investors have really enjoyed jumping on the bandwagon to punish or get revenge on Wall Street firms. But it again just speaks to the irrationality of the equity markets right now. So, with all that said, if you're not already investing in other assets like real estate, now might be a good time to take some of those those wins or take some of those gains and have a closer look at diversifying in other types of asset classes. Mm-hmm. And the reason that I and many other people love real estate is, as you can see on the chart, real estate has outperformed equities by a significant margin over the last 20 years. We're not saying that you should stop investing in stocks altogether. Because if you can stay invested over a longer period of time, then you can do well. We're just saying that if you're not already looking at other ways to passively invest in alternative asset classes like real estate, now may be a good time to take a closer look.
Yeah. Well, those are all good points. And two, kind of like what you just said, and just paraphrasing, it's same thing with real, buy low, sell high, right? Mm-hmm. Where are we right now, everyone? Why would you want to diversify right now? Go back about a year. There was a lot of shoulda, woulda, coulda happening on that phone in March last year. Indefinitely. So, diversify when you are on a high note. To your point, you just made a good one, and I'm going to emphasize it, is time. If you're closer to retirement and you have all of your eggs in one basket, if and when, I'll say when, we do see a correction, because from all of that data, if you're not seeing patterns there, and that's exactly what that's showing, are their patterns. History repeats itself. It's all cyclical.
Yeah.
And the same
definitely,
thing.
Yeah. Sorry to interrupt you there, but definitely seeing a lot more headlines and people on, Wall Street talking about there being a correction. And, Wall Street is very different than Main Street. The equities, stock markets, is doing very well. But if you look at the broad economy, there's the economy is still struggling. People are still suffering. Right. So it's totally disconnected and acting irrationally. Right?
Potentially. I'm going to bring in the simplified logic, what I'm sure a lot of listeners hear is how? How long is that sustainable? When is the when? I always laugh, I'm like, here's the crystal ball. Oh, it doesn't show up on the screen. Yeah. But you don't have a crystal ball. Nobody knows when. So to your point, the question I get all the time too, well, when do I do this? I want to hold off, or, when should you do this is when to figure out to insulate yourself, without taking a huge loss. Obviously, we don't want to see that for anyone. But let's think of this, okay? Just looking at the screen. Okay, real estate is tangible, okay? It is insured. This is another part, so heaven forbid anything happens. Guess where that insurance policy goes? We're talking self-directed accounts here. It goes to the tax sheltered account. That's just even another safety net. It gives you that consistent, predictable cash flow. I haven't looked at the Merriam-Webster's word, definition of financial freedom, but I'm sure that's somewhere in there. Would you agree? You want predictability. It's a marathon, not a sprint. But going back to those that are closer to retirement and you're listening on this, you don't have time to make up a market correction. What will happen as taxes increase here is you will be thrown into even a higher tax bracket that you're in now, and you will be burning the candle at both ends because you'll be forced to work longer. So if you wanted to take out that tax deferred nest egg, you're going to be paying more in taxes. You're just cutting right off of the top of your tax deferred accounts. So that's huge. So timing is now. There's three ways to really do a creative investment, and this is more for a conversation one-on-one, but this is one that most don't know. Will you can purchase outright, you can leverage, or you can partner. So let's say if you're husband and wife, and you have an opportunity for, just for simple math, $100,000 investment. Husband and wife have each $50,000 in their accounts, or they have $50,000 in their personal account, $50,000 in their IRA. Could they still participate in the deal? Sure. Partnering together via undivided interest. We're going to get to this a little bit later, but leveraging is huge, but it's huge to know what type of account to do that in, so you don't trigger this nasty UBIT tax. And so Roth solo 401ks are phenomenal for that. So there are vehicles that you can use that you probably I may be throwing out phrases that you haven't heard of before, but that's where you just ask us, it's all education in our world, you said. We're trying to give you solutions and alternatives. If it works, fantastic. If not, now you know what you didn't know before, and that's essentially what we're trying to do here, is just kind of broaden your horizons to know what type of opportunities are out there. From our relationship, Will, I think it's been very educational and forthcoming, especially with your background. It's how you guys communicate with every client that, we've worked together with mutually. And it's always been a very good experience. So,
yeah. Look, everyone's situation is different. So I think these are sort of broad strokes that we're giving you in terms of that this is a possibility for you to be able to take advantage or take control of your retirement accounts and benefit drastically from it. But everyone's situation is different. Some of you may just need a basic, traditional IRA that's self-directed because you already have a traditional IRA. And some of you maybe need something a little bit more complex or different because you're a business owner, or you're in a business partnership, or you've changed jobs, or you've got a bunch of different stuff out there. And that's where I think, Amanda can be of great value and help for you to figure out sort of the best way to structure what that looks like for you. So,
yeah, absolutely, guys. And this comes back to, not only just like investing 101, but, even how you would operate a business. It's your team, right? Well, you're only as strong as your team. And you want to make sure that your members of your team are looking out for your best interest and educating you on all the possibilities, what makes sense for you and your family. And so that's, I think, one of the unique customizable approach, that I like to see. And that's the good feedback that I get. So kudos to you as well on that note.
Awesome. So why don't we just talk a little bit, or I'll share a little bit with you guys about the the JKAM Diversified Real Estate Fund. And, sort of the reason or the genesis for the JKAM Diversified Fund. It was really born out of investing passively into real estate syndications. So Jack was personally, investing in private real estate syndications, specifically multifamily projects. And he found it, he was working at this last private equity fund, and it's really time consuming to look at each individual multifamily project to find and review one that fits. So it takes time, a lot of time to do that. And then it was also challenging to get diversity among operators and sponsors, or operators and projects, and then also geographies. So, and this is primarily because if you're investing in a multifamily syndication, generally the minimum investment is going to be $50,000. Some of them are higher. Some of them, you might not ever know about because they're off market, and it's sort of a friends and family sort of, capital call. And if you're not on that wait list, then you never know about it.
Yeah. Number one question. So how do you find the deals?
Right.
Because you can't, I can't say, here you go, here's a list, or we're so programmed to, pick from the screen that how do you find those deals? So
and that's really time consuming. And if you're not participating in the industry, it can be even more challenging. So, so this was born, this fund, or this, the strategy of this fund was sort of born out of, Jack's personal experiences of trying to, invest personally in sort of these off-market real estate syndications. And, look, if you've got, $500,000 or more, and all the time in the world to do due diligence and review deals and network and find deals, then you can probably get the similar diversification that you would get in our fund, buying, putting $50,000 into 10 different deals. And that would be great. But that's not most people's story, right? I mean, that's not someone who's working full time, who wants to invest in, self-directed stuff and do invest in real estate, but, doesn't want to swing the hammers or, go over at late at night to fix the plumbing or whatever, because your tenant calls you, dealing with that drama. So that's sort of the reason that this fund came about. And that was to give the passive investor who wants, or who has maybe $50,000 to $100,000 to invest, the opportunity to participate and be diversified in these typically hard to find off-market real estate projects, which, by the way, also have pretty significant tax advantages. So let's just briefly cover why invest with JKAM, and there are really three major reasons. Number one is, with our experience and expertise, you can participate in quality, stable, risk-averse projects that are typically hard to source if you're not in the industry, like we just talked about. You get diversification in our fund. So, for example, you get exposure to many different operators, projects, geographies, and asset classes, which can provide you a balance of cash flow, current cash flow, and also upside potential. And then by participating in our fund, you receive a higher preferred return or lower management fees and a percentage of the carried interest, which you generally could not achieve by investing directly into that project. So I'm running through this pretty quickly because I want to be considerate of your guys' time. So again, here you'll see the asset classes that we invested in the fund. One asset class not shown here is mobile home parks, which we are currently evaluating because of their significant tax advantages. But the majority of the capital that we place in our fund is going into multifamily, value add type of projects, senior housing development, and we do some loan acquisition because, that's Jack and I's really our specialty. The last fund, we had $3 billion in assets under management, and it was all non-performing loans or reperforming loans, sort of in that space. So
gotcha. So diversification in one-stop shop.
Yeah. I mean, just, sort of the purpose of this, or the strategy behind this, is the multifamily is fully stabilized, fully occupied, fully performing, provides, cash flow immediately, right? So we have a stable asset that provides great current cash flow. The development and construction projects, which is mostly senior housing, we don't see any cash flow from those projects for the first 2 years, but the return on investment, or the IRR on ground up senior housing, is very good. It's like north of 30%. So, and then the loan stuff is a small allocation in our fund, and that's something that we also know really well, and the return on investment is very high. So we got the nice stable cash flow stuff where, returns are mid-teens, which I guess is maybe boring to some, but amazing to others. But anyways, moving on. So here are a few of the projects that we have in the fund right now. We've got a multifamily in Lexington, Kentucky. We've got one in Greensville, South Carolina, one in Jacksonville, Florida, one in Atlanta, Georgia, one in Augusta, Georgia, and one in Phoenix. We're thinking about, or we're planning the next asset is going to be right down the street from this one in Atlanta. It's the same operator, so a good opportunity there. So we'll ultimately have probably between 15 and 20 different multifamily projects in the fund. This is just interesting, I thought, the stability of multifamily. If we look at what we've seen over the last year with multifamily rent collections, you may be surprised that even during a pandemic, that the collection rates have remained relatively high. So the national rent collection is greater than 76%, which, is a slight decrease from last year. But we have seen an increase since December. And the interesting thing, though, is that JKAM, our fund's assets have a 95% collection rate on the projects that we're invested in. So they're all the projects that we're invested in are done by operators that have been in that business, in the multifamily space for a long time, and have great teams and processes in place. So let's just talk briefly about the diversified fund expected returns. We're targeting a 15% IRR, cash on cash, or the dividend or the preferred quarterly payment for you guys is anywhere from 6 to 8%, depending on which share class you come into. Our minimum is $50,000, and we're looking at raising $15 million for the fund. So if you want more details, content, or just more information, you can go to jkaminvestments.com/financial freedom and download the field guide, which has a lot more info on what we talked about today. And then obviously, Amanda and I would welcome your connection if you have any questions or feedback beyond today. We'll make ourselves available to chat with you if necessary, or if you want to.
Say, well, one thing I'll do, for anybody that's listening, I'll give you, time is precious. And I think one of the things that's a big value add is you guys are, you're doing the vetting and the due diligence process, which that right there is a huge value add. Plus you are making up opportunity cost of missed if you were trying to be the one-man army. Again, this is just, my summarization of this, but.
Yeah. And that's a great point. It can be literally a full-time job, doing the due diligence and, investing in all these projects. And then there's paperwork, right? So look, if you there's just a lot of little stuff that we just eliminate. We just it's a shortcut button for you. So
that's exactly, and even from our end on Specialized, we make it turnkey for you too.
Exactly.
Anyone listening here, I'll share a link to my calendar, more than happy to hop on a call. If it's just education, that's great. Would love to work with you, but at least, you get a feel for kind of where you're at and what opportunities and what vehicles that you're able to move, in and around, whether it's your IRA or family members' retirement accounts, et cetera. It's, again, another tool in your toolbox. And, the only way you're going to see change, is if you take control, and you make those changes yourself. No one's going to do it for you, just to your point, Will. So we're here to make that easy. That's the right people in the right seats, right? You assemble your team, and then go from there. So I think it's a great model that you guys have. And, we enjoy working with your team and our mutual clients. It's been very, synergistic. I think
absolutely. And look, obviously, we would welcome any contributions to our fund. That would be great, but this isn't exclusively about us. This is about you learning about the opportunity, if you don't already know, of self-directed IRAs and how that can be a really powerful wealth creation tool for you. And so you can, make a contribution to our fund, or you can make a contribution to a variety of other different places. But just know that there's a much better way for you to be saving your money in tax deferred accounts than your old 401k sitting off.
Pay yourself first versus Uncle Sam. And again, one thing I want to mention before the end, they extended the deadline to May 17th. So
I was so happy to hear that.
Yes, they extension vote. But that means you can get your contributions in for IRAs, Roth IRAs, traditional IRAs, HSAs, your SEP IRAs for my self-employed folks. You have tax filing plus extensions if you're part of my October crew. But those are important deadlines. These are incrementally growth over time. So put them in your buckets and get them growing, not only just for you, look it for your kids. I always laugh. You can't see the pictures behind me, but you would see my smiling, 9-year-old and 4-year-old, and guess what? They self-direct. We practice what we preach around here, right?
Yeah, start them young.
Yes, start them young. Compounding interest over time is a powerful tool.
Yeah, absolutely. Okay, cool. So why don't we answer some questions, and if we have any right now. So let's go ahead and jump in there.
All right, shoot them out there. Would you guys like the radio version of the disclosure?
Yeah. And while we answer some questions, let's look at this disclosure here. Huh?
You don't need to look at disclosure. We don't recommend.
Well, why don't we go back to
our
contact info there? Nice. Doesn't look like we have any questions at the moment, but you have our contact information, so you can reach out to us afterwards if you'd like, and we'll go ahead and catch you guys all on the next one.